What is going on, everyone? Welcome on into today's video. We just recorded an awesome interview that we've got lined up for this video. We have a special guest, Zoheb from the One Glance Trader channel. He's been on YouTube for quite some time now and been documenting a lot of his types of strategies and his process, all starting from back when he was trading Forex to now how he's kind of adapting a fundamental approach to selling premium and how you can kind of do the same thing. And he's going to walk us through exactly how his mind works and how he uses some indicators and how he uses numbers to make things super easy on himself and his portfolio. And real quick, before we get into today's interview, this is a bit of a longer video, but at the end of the video, we're going to have some details on a giveaway that we're going to be doing. And I want to make sure that you guys at least know of that before you dive in case you wanted to jump out early or in case you didn't have time to watch the entirety of this interview all in one sitting. Make sure you at least pay attention at the end where there will be those details to get access to the giveaway that we're going to have in the next month or so. So let's kick it over to me in the past and let's dive on in.
Welcome on in, everybody. This is Zoe. We have a really good interview planned. I just kind of gave you an intro. So I want to dive right into what you're all about, who you are, what got you into trading and investing. And then I definitely want to hear how you're able to pinpoint the prices that you want to buy stocks and some examples on that. So I'll leave the floor to you.
Perfect. No, appreciate it, Thomas. And firstly, thank you for having me on your channel. It's a great pleasure. So, you know, I'm Zoheb Noormohamed. I've been trading now just over 10 years or so. And I initially got into trading into Forex. You know, we all kind of look at those how to make money online type things. And, you know, Forex trading kind of fell into it. And it's the typical story of, you know, was a losing to break even trader at best. And then I came across this what Walter Peters, I don't know if you ever mentioned Walter Peters, of the Naked Forex, where he talks about various price patterns. And I then became obsessed with, you know, looking at price patterns and all these kind of good things. And I was trading using MetaTrader 4, and I created his pin bar indicator, or his pin bar set of rules in his book. I created an indicator. Again, you know, you can get all this free at my YouTube channel. I'm sure you've got all the links, and you already mentioned that already. But yeah. He had a set of rules, and then I just used this one price pattern for Forex, and you know, my returns absolutely skyrocketed. So, you know, fast forwarding a couple of years using this indicator, I was making about anywhere between 10 to 20% a year. The only drawback that I had with, you know, trading with Forex is it's very intensive, you know, time on the chart. And yes, you know, I built a lot of EAs and tried to do automated trading and stuff, but there was still a lot of time invested looking at the various charts and the price patterns and all these kind of good things. And then I came across this Ryan Daniel Morang YouTube video where he said make passive income through trading options. And I heard about options before and all these kind of good things, but I didn't really understand what he was talking about, if I'm really honest. And I had to watch the video a couple of times. I think he sold a put on IBM and how he made like $40 or something on those lines. And after the fifth time of watching that video, it actually started to make sense to me about how you can buy a stock at below the current price and get paid to wait. And that was the most interesting thing when he said get paid to wait. And ever since then, I've been hooked on trading options. So I know you use Interactive Brokers, and you know, and I use them as well. And I started on a paper trading demo account, and I sold a few puts on Apple and Google and Tesla and all these kind of different things. And I'm like, wow, this is amazing. I'm making like, you know, a few $100s a month just on simulated trading. So I remember it was about 2.5, 3 years ago where I sold my first ever real life put. I put like 15 grand in. Sold my first put on Apple. I think it was at the 120 strike for like $40 for like a 2-week out option. And since I placed it, Apple then skyrocketed up to like 135, 150 or whatever it was. And that option like was like pennies within like 3 days. So I bought the option back and, you know, cooped in 90% of that value, and then did it again and again. And then I started to go on to a whole range of stocks. And for me, as my education grew in terms of stocks, I was then looking at it and trying to understand, actually, I actually like Apple, I like Tesla, I like Google, I like all of these stocks, but what price? Because the fear of selling puts, I'm sure your audience knows, is what if I get assigned the option or price
Exactly.
tanks below my current strike price? Is I'm going to get assigned 100 shares, which I had cash for, which is not a problem. The problem was Apple actually worth $130 per share? Is Google actually worth, well, back in the day before they're split, like $200 a share, whatever it may be? And that led me down the path of looking at the concept of value investing and intrinsic value. And what I'll do actually is I'll share my screen with you, and I'll kind of show you what I mean. So hopefully you can see that.
Yep.
I got this image up, in prep for this interview. And for those of your audience that are new to intrinsic value, it's trying to value a company. And this graph explains it really, really well, of where you got value over here and time across here. And as you can see, as well as anyone, that stocks just don't go in a straight line, right? They go up and they go down, etc. And what we're trying to do as value investors is trying to calculate what that intrinsic value. So as a stock goes up, the intrinsic value goes up over time. And at any point in time, if the current price was here and intrinsic value is here, you're currently overpriced. So now is not the time to buy the stock. A classic example will probably be Tesla in today's world. Another example is as time goes on, let's say the price is down here and you believe intrinsic value is here, like Meta stock for a classic example, which I think is still, even after its bull run in January, is extremely undervalued. This should be an opportunity now for you to start acquiring shares. So the main question then becomes is, how do you calculate this line over here? And there's mainly three schools of thoughts on this. The first way is doing it through an earnings valuation model. And what we'll do today is, as part of the value add inside this video, I'm going to share with you a free TradingView indicator where you can calculate the intrinsic value of any stock using this earnings valuation model. So hopefully that's going to add a lot of value to your audience. The second way is using discounted cash flow, so understanding what the cash flow and what those future cash flow earnings are going to be. And there are obviously a lot of stocks that produce negative cash flow and have negative earnings, so you can use a price to sales ratio kind of valuation to kind of do more growth stocks. So I kind of stay away from growth stocks when it comes to value investing, because I like to have companies that have earnings and have more solid fundamentals kind of behind them. I do trade options as well, which is if we do a follow-up video, I'll show you kind of my trading strategies, and that's where I get involved in a lot of the growth stocks, because I'm not looking to own those stocks. I'm looking to kind of trade them off their kind of volatility that they have. Okay. So what the key challenge is we try to find out what the intrinsic value is, and we'll go on to that in a second. But once we know what the intrinsic value is and we're happy to buy this stock at this certain price, what we're then going to do, we're then going to utilize options to get paid while we wait for the stock to get down to that price. So back to that Ryan Daniel Meringue video that I saw when he put a put option on IBM, we're going to start placing puts on companies below their intrinsic value. And the stock may never get there. However, but you're going to get paid every single month until the stock does get there. And if it doesn't get there, you're making monthly cash flow, a few hundred to 1,000, depending on what the stock is, how volatile it is, how many contracts you want to put down on the option. Or the best case, as I like to say, is that the stock then closes at or just under your intrinsic value. You get assigned the shares, and then you start selling covered calls on there to start making money on the other side of the equation. So if that sounds good, let's dive into it, unless you've got any questions on intrinsic value or anything.
No, that sounds good. Let's dive into it.
Perfect. And I know we spoke offline before, and I know you're interested in Google stock. So what I've done is, for this example, is let's have a look at a Google stock. So,
Okay.
so we've got Google's chart up here. It's on the 1 week chart, and again, we're not really looking at RSI oscillators and all these types of traditional technical indicators. What I've built again is absolutely free for TradingView. All you need to do is head over to the indicators tab and type in OGT. Intrinsic value indicator here. So it's this one here for one glance trader. So that's mine. I've got a number of indicators. Again, they're all free for TradingView. So I've already got it up here, and what I'm going to do is just uncheck it. Now there's a number of things that are appearing on here, and I'll walk through what each one of those are. So on the right hand side here, we've got a table view of the input settings that we're going to walk through for Google. Now, these are just some of the default settings, so we need to change this based under our assumptions for Google. We also have, which is kind of covered here by this section here, but it shows you the current trailing EPS, which is the earnings per share of Google, which I think is around $4 something and some change. And once we go into it and input the values, what it does, it kind of tells you, gives you 3 numbers here in terms of what price you should be paying today for Google in terms of its intrinsic value. So again, these numbers here are going to change when we play around with the input settings, and I'll show you how to get these input settings for free very, very easily for any single stock. So what we're going to do is we're going to go into the settings. And then again, you can turn off the tables and the lines and things like that on this indicator, but we'll keep everything on now. Now there's 3 input sections that we need to put in. We need to put in what we believe the future earnings growth rate is for the stock. So in this case, Google. What is your annual return that you want to do, and the PE ratio. So this is a 5-year kind of looking forward forecast assumptions that we're going to put into for Google. So the first one again is the EPS annual growth rate. How in the next 5 years per year, what is the compounded annual growth rate for Google? Now, the first place I like to start is Yahoo Finance. And if you type in any ticker symbol and you head over to the analysis section, it tells you all the estimates for all the analysts that are looking at Google. And if you scroll right down to the bottom, it's got a section called growth estimates. And what you want to look at is next 5 years per annum. And at the moment, you can see here, it's got 15.51%. So what it's saying is over the next 5 years, all the analysts on average believe that Google's earnings compounded will increase by 15.51%. And what the indicator has is it allows you to put in a low, medium, and high assumption. And your highest assumption is your most bullish case, and shouldn't be, and obviously low should be your most conservative case, and you've got your mid case there. And what I like to do is, because analysts tend to get things wrong, I like to use analyst assumptions as my highest assumption, so I know where analysts are kind of placing out the stock, and I kind of work my way down from there. Now there are paid tools and things that you can use to help you with some of this stuff, but again, just for now, the quickest way is to go on Yahoo Finance, type in 15.51%, and then I'm just going to go with 13 and 11. The lower you put these numbers, the lower the intrinsic value is going to be. So that's how these impact the value. And the next one here is your annual return. Now, what the annual return looks at is how much do you expect Google to appreciate over the next 5 years? Now, because we're investing in an individual stock, and again, you can put any numbers inside here that you want. I like to put in higher than what the average of the S&P 500 does in. So the S&P 500 ranges around 8% over the long term. It's a lot higher in 2023, then it was a lot lower in 2022, but over a long term, it averages out at about 8%. So on my lowest assumption, because it's more risk to invest into Google, I want to make sure I'm getting more than a 10% return on my, more than an 8% return on my investment. So I'll go in with 10%. Yeah, and then for medium, I've gone with 11. Let's say 11, and then for high, I'm going to go for 12 and a half. If I'm going for a more volatile stock like Tesla, my highest assumption will probably be 15, 16%. And how this figure impacts the lines is the higher the number, again, the lower the intrinsic value. Because again, we want to buy this stock as low as we possibly can, right? And then the last factor that comes in, you can see that everything moves around, and we'll look at this table to bring it all together so you can kind of see what this looks like, is what is the PE ratio in the next 5 years? So this is the compounding figure of what we're going to times our year 5 share price by to work out what that intrinsic value is in year 5. And then you use your annual return to work backwards to get to today's pricing. So that's how this kind of model works. And the easiest way to kind of do that, and again, this is very subjective as well. So I encourage, people that are using this indicator to put the lower numbers. The lower the number, the more conservative you are going to be in terms of your intrinsic value number. I like to use Y charts to get a historical gauge. Now, if you Google Y charts, Google PE, for example, and click the top link, it will take you to this page over here. Again, this is Y charts is a paid service, but you can use this to get the information you want. You can get this for free. What you need to do is go to the PE range over the past 5 years. And what we want to look at is the average. So the average PE in the last 5 years for Google is 30.66. So the question I asked myself is, where is Google in the kind of life cycle? Is it still a startup? Is it a growth? Is it a mature company, etc.? And you take something like Apple, that is a very mature company. Like, is Apple's earnings really going to compound? I think Apple's average PE over the last 5 years, 25. Do we really think they're going to compound at that rate in the next 5 years? Probably not. So, and that's what I take here. I use this gauge as the average, and we have a minimum here of 15.8 and I think a maximum of 64.84. So what I'm thinking at for Google is going for a PE on the high side of 20, going for 18 on the mid range and 16 for the low. Again, you can go lower than that, you can go higher than that. Again, it's completely up to you. So does that make sense? You got any questions on that, or does that kind of make sense of how
that
and
makes
where
sense.
to input these things?
Yeah, and it depends obviously on the type of stock, you know what I mean? Like at this point, and it takes, some understanding too of, the markets, and, you can't just come in here and assume that, that a bull market's going to go on forever and ever and ever. And these PEs are going to go crazy and crazy. You got to take a step back at some point and go, okay, let's think about this, logically here. Right. And, what stage. I think that your analogy of like the life cycle makes a lot of sense.
Yeah, no, definitely. And we'll go on to the lines in a second, but if we have a look here, and this kind of takes how all the calculations and assumptions we've put in brings it all together. So if we have a look here, the current year 1 earnings for Google for the trading 12 months is $4.49, which is this figure here, which you can't see, but that's what that is. And what it's doing is assuming at a 15.51% increase, it increases it for the next 5 years. So if we keep trailing it by 15.51 in year 5, it would be worth $7.99 per share in terms of Google earnings. And then what it does, it times it by your highest assumption for your PE, which was ours was 20, which then gives you an intrinsic value in year 5 of $159.80, which you can see over here in year 5. Then what it does, it takes your annual return. So I think our case for the high assumption was 12.5%. And discounts it back for 12.5% every year to give you your year 1 value of $99.76. So what it is saying is, if you believe that Google is going to increase their earnings by 15.51% with the 20 PE in year 5, and you want to make 12.5% return a year, the intrinsic value of Google currently is $99.76. Does that make sense? How that calculation comes about?
Yeah, that makes sense.
And it does the same thing for the 13 and for the 11%. And again, now hopefully you can see is how you can tweak these numbers of how it will change these kind of lines here. So what it's saying, Google currently is trading now at 94.59. If you believe your high assumptions, Google is currently below its intrinsic value. So if we go back to here, it's currently at this level here, and Google is potentially a buy for you at this current price. Now, again, I like to look somewhere. I don't take these as hard and fast, kind of lines. I kind of look at them at ranges where at the moment it's somewhere between your medium and kind of high assumption. And just I think it was recently, when was this, back in October last year, it got to lows of 83.45, so even below your medium assumption. So let's just say now that you think $85, for example, is where you would like to buy Google a Google stock at $85, right? And so we've still got a way to go to kind of get there. So what people would traditionally do is just put a limit order at 85 and just wait for the price to get there, right? And then your order would trigger, and then you would buy shares of Google at that value. Now, what I like to do is use options to do this, right? So I'm going to just head quickly over to Webull. And I like to sell options anywhere between 30 to 60 days out. And so I've chosen the 40-day expiration cycle. So we head over to puts. And I think, I can't remember what I said there for a second. I said $85.
85.
So if we go to the $85, right? Again, these are some wide spreads here as the market's closed. Let's just take this mid price for now as an example. We can get paid 68 cents per share. And if you're doing one contract, that's 100 shares. So that's $68 to sell a put on Google. And again, for viewers that aren't new or new to options, what you're saying is I'm willing to buy 100 shares of Google at $85 at any point between now and the next 40 days. And the option buyer would pay me roughly around $68 for that right? So I'm happy to buy Google shares at $85, but I just got paid $68. Now, three things can happen at this stage, right? Over the next 40 days is Google could stay above $85 or go higher. If that's the case, the option would expire worthless. I would keep the $68, and then I'll sell another option at 85 for another 40 days out and continue to make cash flow. Google could go down all the way to $88 or $86. The option would still expire worthless because you're not at your strike price or below, and therefore the option will expire worthless. You keep the money, then you can sell another option. And the beauty about this is, if you're still happy with 85, because your new option will be closer to the money, you'll actually make more money. So if we go back here, and you can see here that the at the money options are a lot more juicier because the probability of them being in the money is a lot higher. So you can make quite a lot of money if you find stocks that are currently under intrinsic value, like Meta, in my opinion, or stocks even like Google, if it was to continue going down slightly. And then the last case scenario is that Google absolutely tanks to $60. Now, the disadvantage of this is that you've entered a contract, so you are forced to buy the 100 shares at $85. But even if you had a limit order, you still would have got own the shares at 85. But at least you got paid $60 to wait, which will lower your cost basis slightly, or you can use that $65 to go buy more Google shares in the future. So that's kind of how it works. And again, I do this on a number of stocks, especially like the big ones like Tesla, Apple, Google, etc., Meta. And again, I do own, full disclosure, I do own 200 shares of Meta, and around the $80 mark, where it was about December, November time, where it was after earnings, where it absolutely tanked. I got earlier signed on some shares. Then I did some more puts at the money at around the 80 mark, which I've also got assigned on. So I have a pretty low cost basis, and I think let's have a quick look now. Actually, I think Meta is 150 odd, something like that, 172 now, within there. Saying here that I think is gonna end soon, so I'll keep this. I'll wrap it up there. because I'm keen to get onto the free giveaway. If you want to quickly have a talk about that, and then we can show you how you can earn it.
Yeah, sure. No, this is awesome. This makes it super easy to visualize, I think. And so it's going to be very helpful, especially because it's a free indicator over on TradingView. So thanks so much, Zoheb. I want to kind of dive into this giveaway. So really quick, you're giving away a 3-month TradingView Pro subscription. Now, to qualify, you need to be a subscriber of both of our channels, and those links will be in the video description box down below. And on top of that, leave a like and a comment down below on this video with your top indicator that you like to use. It could be really whatever you want, whether it's fundamentals, technicals, doesn't matter. And we're going to be picking a winner within the next month or so, you say?
Yeah, no, definitely. Yeah. So what we'll do, yeah, me and you will just copy and paste them, stick them into a random picking generator, and then what you do need a TradingView account, because what I'll be doing is gifting you the coins, which equals to the amount of a 3-month TradingView subscription. So yeah, make sure you subscribe to Thomas's channel if you're not subscribed already, and also to my One Glance Trader. Check those out, links are down below. But yeah, no, if you guys have any questions on selling options or selling puts, all that kind of good stuff, comment down below inside this video. I'll be actively around on the chat over the next few weeks, and yeah, looking forward to hearing you guys selling puts on at below intrinsic value. But no, really
Awesome.
appreciate your time, Thomas, as always.
I appreciate you too. Thanks so much, and we'll see you in the future.
Cheers. Take
Peace.
care.